Are you ready to decode the complex dynamics of today's economy in just minutes?
Absolutely. Let's hear from our experts, including Danielle DiMartino Booth and Stephan, whose insights are laser-focused on crucial market shifts.
We've distilled their hour-long analyses into bite-sized segments that deliver essential strategies and forecasts, saving you time and helping you succeed.
Stick around. We'll cover how the Federal Reserve's interest rate cuts directly impact job market growth and housing recovery, plus much more.
Today, we're discussing how the Federal Reserve's actions could affect job market dynamics.
Danielle's insights highlight the challenge of balancing inflation control and job support.
Danielle DiMartino Booth explains that the Federal Reserve's interest rate adjustments will play a key role in job market growth.
She emphasizes the importance of tracking inflation as it shapes the labor market's future. Danielle notes how the Federal Reserve's monetary policy directly affects job creation.
Why are these interest rate changes so significant?
These changes can either stabilize or destabilize job levels.
What does Danielle predict for jobs as the Federal Reserve adjusts its policies?
She believes job market stability will heavily rely on the Federal Reserve's reaction to economic shifts.
Danielle concludes that businesses must respond to monetary policy changes in hiring.
Job seekers must also be aware of market volatility and plan their job search strategies.
Today, we delve into Stephan's analysis of the Federal Reserve's recent decision to adjust interest rates.
Stephan emphasizes how this move could significantly impact economic growth and borrowing.
Stephan argues that decreasing rates can foster economic growth by promoting investment and consumer spending.
However, he cautions that this approach could lead to inflation if demand exceeds supply. Stephan explains that lower interest rates make borrowing cheaper, potentially leading to more consumer spending and business growth.
What concerns does Stephan cite regarding inflation?
Stephan warns that higher spending could drive prices up faster than wages.
What does Stephan predict for the economic outlook?
He anticipates that if the cuts succeed, a sustained economic recovery could follow, but managing inflation will be essential.
Stephan concludes by stressing the need for vigilant monitoring of inflation rates.
Investors must remain aware as changes in rates can affect their financial strategies.
Today, we're analyzing predictions by Gammon about the possibility of a market crash.
Gammon highlights crucial economic indicators that investors should monitor closely.
Gammon posits that the market may be on the brink of a significant correction.
He links this to current inflationary pressures and upcoming Federal Reserve decisions.
How does Gammon frame the relationship between inflation and market stability?
Gammon argues that persistent inflation sets the stage for market disruptions.
Highlights that rising interest rates can limit market participation.
This shift could lead to lower liquidity levels and increased volatility.
What does forecast for the market in the next year?
Gammon predicts possible stabilization if inflation is controlled. Otherwise, a downturn is expected.
In summary, what actionable advice does provide for investors?
He suggests diversifying portfolios and exploring conservative investments as safeguards against volatility.
Today, we're exploring an analysis on the housing market by Nick Gurley, discussing the recent plunge in mortgage rates to a 3-year low.
Gurley's insights shed light on how this decline could rekindle buyer enthusiasm and invigorate the housing market.
Nick Gurley argues that the drop in mortgage rates may entice potential buyers back into the market.
Indeed, Gurley points out that as borrowing becomes cheaper, we can expect to see more buyers enter the market. Gurley highlights that improved affordability from lower rates can revitalize buyer sentiment.
That sounds like a major shift in market dynamics.
What are Gurley's predictions regarding future market activity?
Gurley anticipates that if buyer enthusiasm grows, we may see home prices start to rise again.
In conclusion, Gurley emphasizes that buyers need to stay alert for signs of changing market conditions.
Absolutely. He encourages tracking mortgage trends and market activities to make informed buying decisions.
Today, we're examining a detailed analysis on the current state of the housing market.
The expert identifies that a major portion of homes are experiencing significant value loss signaling a shift in market dynamics.
The expert outlines concerning trends indicating home values are declining.
This decline correlates with rises in interest rates, contributing to market adjustments.
How does the expert relate rising interest rates to diminishing home prices?
The expert explains that inflation of rates leads to affordability challenges, thus decreasing home buying demand. With home values plummeting, the expert observes a growing caution among investors.
This caution mirrors rising concerns over the market's overall stability. What predictions does the expert offer for the housing market in the near future?
The expert anticipates additional declines if the economic state worsens, yet stabilization could occur should interest rates stabilize.
What recommendations does the expert have for buyers and investors as we conclude?
The expert advises buyers to be strategic about their timing in the current market, while suggesting that investors should adapt their strategies to respond effectively to current market challenges.
Welcome. Let's explore Ted Oakley's thoughts on the current market conditions.
Oakley raises concerns about factors that could mirror those leading up to the tech bubble.
Ted Oakley points to current trends that may reflect past bubbles.
He emphasizes the unusual valuations occurring in major tech stocks. Ted Oakley identifies tech stock valuations as alarming.
It's crucial to remember that history tends to repeat itself. Ted Oakley notes rising market volatility as a sign of investor caution.
Such volatility suggests apprehension and a retreat from riskier investments. What are Ted Oakley's predictions regarding future market behavior?
He warns of possible corrections based on collected data and trends. Ted Oakley believes we may experience corrections soon.
He underlines the need for cautious investment approaches.
Ted Oakley highlights the importance of adaptive investment strategies.
Investors must remain engaged and responsive to market signals.
What an enlightening session. We've had some heavy hitters in the financial analysis space today.
Definitely, starting with Ted Oakley, who raises a strong caution about market signals that remind us of past bubbles.
Right. And then we had the real estate expert discussing the decline in home values, definitely a red flag for potential buyers.
And let's not forget Nick Gurley, who argues that lower mortgage rates could actually inject some life into the housing market.
It's a curious contradiction, isn't it? While certain experts are warning of risks, others see opportunities.
Exactly. George Gammon emphasizes the need to monitor economic indicators, reinforcing that these are uncertain times.
And Stephan adds another layer by linking the Federal Reserve's actions to potential inflation risks.
Danielle DiMartino Booth brings it home by discussing how Fed policy changes could impact jobs and inflation dynamics.
This diverse landscape of opinions gives viewers a lot to ponder. If these insights have sparked your curiosity, hit that like button.
Absolutely. And subscribe for even more expert analyses. Your support empowers us to keep delivering top-notch content.
Stay tuned for our upcoming videos diving into the ever-evolving financial landscape. Trust me, you won't want to miss it.